Somebody call 911.
Now to today's Money 911. This morning, trying to help you get a handle on your debt and save for the future during a tough economy. Sharon Epperson is CNBC's personal finance correspondent. David Bach is the founder of FinishRich.com and author of Start Over, Finish Rich. And Carmen Wong Ulrich is a personal finance expert for CNBC. Good morning to everybody.
Good morning.
Thanks for getting in here on a snow day. We appreciate it. I know because probably, Sharon, your kids are off from school just like mine.
That's right.
Hi, Jack. All right. Well, here we go. We've left them home with plenty of kibble. We got issues related to credit card debt. Let's start off with Tina from Pennsylvania. She sends in an email. She says, I was an authorized user on my mother's credit card. She is currently unable to pay the debt. Now I'm getting contacted by a collection agency. Am I liable for this debt? If so, how can I stop these calls? So, Sharon, what happens to an authorized user? Is she responsible?
Well, Tina's figuring out that there's a downside and there's an upside to being an authorized user. An authorized user, the upside is that you get the charging privileges, but you are not responsible for paying off the debt. So that's what she needs to tell these collectors. She needs to let them know that she's an authorized user. If she gets any resistance from them, ask them for that credit application that shows that she's an authorized user, not the primary card holder, not a co-applicant.
So what's the downside?
The downside is that your credit history is still affected by this primary card holder.
Wow.
So while it can be a great way to build credit if you have somebody who's actually paying the credit card on time, if they're not paying on time, that's going to affect your credit history and your credit score. So it is worth, if she has the money, paying off some of that debt.
Helping her mom pay it off.
Exactly.
All righty. Now, let's go. We're going to go to Naomi, who's joining us via Skype from Maryville, Indiana. Good morning, Naomi. How's your weather there?
Hello, Naomi.
Naomi's out. Okay, I guess the weather's not that good. Okay, now we've got a viewer video question from Julie in New Jersey. Take a look.
Hi, I'm Julie, and this is Joe from Union City, New Jersey. Last week, Joe had his christening and received savings bonds and cash as gifts. My question is, do I use the cash to buy more bonds, put the money in a CD, or leave it in a savings account?
Joe looks like one of those E-Trade babies.
He's
so cute. So, Carmen, what should Julie do?
What great gifts. I mean, here's the thing. Those E-bonds, just so folks know, I mean, this is a fixed rate bond, about 1.2% right now. Not a lot of muscle in there, you know? I mean, I want more muscle in his money. And also, too, what are you going to use this money for?
Right.
Is this going to be for his daycare, or is it going to be for college? If it's for college, look at 529s. Tax-free growth there. Lots of options to grow the money. Go to savingforcollege.com to look up your options there. And if it's short-term money, if this is money she's going to use to say, fix up his room and give him a twin bed, that sort of thing, then you want to keep it in something short-term, like a high-yield savings account or a short-term CD. We're talking about 1.42% right now if you go in.
Okay.
Yeah, split the money. Split the money in a
Split
couple
it.
of parts.
So it depends on what you want to use it for.
All right, now we've got a viewer call. This is Sarah in Pittsburgh, Pennsylvania. Is it still snowing there, Sarah?
It is.
Uh-oh. Well, hopefully you're nice and safe and dry. What's your question for our panel?
Well, we have a lot of credit card debt, and we're just barely making our minimum payments along with our mortgage and other bills. We do have about $60,000 to $80,000 in equity. Does it make sense for us to refinance and pay off some of our debt, and we'll be able to qualify with so much unsecured debt?
Sharon, what do you think?
Well, that's a lot of credit card debt, and I really feel for you. But you really need to, first of all, cut up those credit cards. That's the first thing. Please don't use those credit cards. The other thing that you need to think about is whether or not you will be able to refi. You may not be able to do that. You may not have that opportunity, but it's worth looking into. Realize, though, that a lot of these lenders are going to want to see a debt-to-income ratio of 45% or less. So if she can't combine that new mortgage and credit card debt and make sure that is less than 45% of her income, she may not get it. At the same time, she needs to have a plan on how she is going to reduce her debt. So in addition to cutting up those credit cards, what are you going to live on? That's all that you need to think about right now, just the survival instincts, and cut out everything else. Also, you need to think about how you're going to raise your income at this point, whether or not it's getting another job, which might be very difficult in this environment, or trying to sell some of the things that you have in your home, either on eBay or have a rummage sale or something like that. That's going to be critical, but you really have to have a plan on how you're going to reduce the debt at the same time that you're going through this refi process. And everybody who's going through these processes with lenders needs to really keep detailed notes. Who did you talk to? What time? Note everything, because you may not talk to the same person twice.
A question for David. All right. This comes from, it's an email from Solana in San Diego, California, writing, I've been hard hit with credit card foreign transaction fees. I understand that very few banks like Capital One don't yet charge such fees, but heard from a Bank of America representative all banks will charge foreign transaction fees, including ones that don't currently do so. Is this true? If so, when? Any tips on avoiding such fees?
Okay, first of all, I'm going to take out a little violin for Solana here.
Because she's somewhere.
You're traveling abroad. So first of all, financially, we know you're doing pretty well if you can afford to go abroad right now. Really, the real problem when we go abroad right now, Al, is that our dollar's weak, so our money doesn't go as far. As far as these foreign transaction fees go, you're not being killed by them. They're running 1 to 3%. That's the cost of now using your credit card abroad. And quite frankly, if you actually buy things abroad from the U.S. right now, you're also getting hit with a foreign transaction fee. Again, it's 1 to 3%. We're going to see most credit cards go to, I would say, an average of 2 to 3%. If you want to compare all the credit cards' foreign transaction fees, what you can do is go to a website like creditcard.com. That's where I went. They've got all the different credit cards on that website showing what the foreign transaction fees are. You can also call your credit card company and ask them. The problem is a lot of people on the phone don't know the answer. So the simple thing to do is actually go online to the credit card company that you have and click into the area that's got all the legalese around your credit card, and it will show you your foreign transaction fees. But again, they're about 2 to 3%. That's not going to break your bank if you're traveling abroad.
That's right. Solana should bring us something back, too.
Yeah,
okay.
exactly.
Now let's go to a live video web question. This is Alita in Clarkson Valley, Missouri. Good morning, Alita, and what's your question?
Well, in 2002, my husband and I put a contract on a home, and the contract came back that our building was not in a hazard flood area. Okay, so we got the loan, and 4 mortgage companies have had this loan through one merger and 2 different takeovers. So no flood insurance was required. We bought the home in 2002, and then in 2007, Countrywide took over, and they said that we needed, we were in a high-risk area, and that we needed to cover the amount.
Okay, so you know what, Alita, we're running out of time, so I'm going to let Carmen just jump in here, okay?
Alita, here's the thing that most people don't realize is that when you get your mortgage, right, they can change the flood insurance requirement at any time. Now, you said this was 2002. That can change. So now, to 2010, you may need flood insurance, and your zone where you live may now be a flood zone. If you disagree, you can both, yourself and your lender, go and repeal this at FEMA, appeal this at FEMA. So go to FEMA.gov. They have a section right there on the homepage on the right for flood insurance, and you can appeal this decision. Now, if you really need flood insurance, get it yourself. It's much cheaper if you get it yourself than if you let the lender get it for you.
And it's probably better off to have flood insurance anyway.
Well, I was just saying, because if you appeal this and they accept it, and then there's a flood, and your home gets wiped out, you're destroyed. So, I know it's expensive to have flood insurance, but I've owned homes that require flood insurance.
Hers is about $5,000, which is very expensive on a $150,000 mortgage. But, Alita, you just got to know what your rights are, and know it's very expensive for her. She can't afford it. So you really need to do your research on this and go to FEMA.gov.
Okay, we got
independent agent.
Okay, we got to leave it there. Sharon Apperson, David Bach, and Carmen Wong Ulrich, thank you so much.